Advisors or panelists on the line. When you are ready to begin the presentation, press the Start Broadcast button on the GoToWebinar control panel to allow all attendees to hear you. This system will notify you once you begin your broadcast. The broadcast is now starting. All attendees are in listen-only mode.
All right, and then can almal my nou hoor? Okay, so let's Nadia, so let's kort wag net tot so 12 uur en dan sal ek begin met my slides.
Sorry, Errol? Errol?
Yeah, so this will show us.
Errol?
Yeah, so yes. So, but it will show us.
Kan jy sien hoeveel mense het al aangesign aan jou kant? Nee. Errol?
Ek het my unmute aan hierdie kant, hoor?
Okay. So, daar's 96 mense het geregister, maar nog net 15 is op. Ek weet nie, wil jy net vir hulle sê, jy wag net nog 'n bietjie vir ander mense om aan te sign.
Nou maar ek sien nie die name nie. Hoe gaan ek die vrae sien?
Ek gaan vir jou die vrae lees.
All right.
Ja.
So watse mense kan jy sien is aangelog?
Daar's oor die name hier van die mense. Okay,
Jy
Melissa.
kan almal sien daar. Ja. Jy het jouself gemute nou, né? Right, so jy kan hom. Daar's hy. Nou is ek reg. Okay. People can hear you. Oh, they can hear me now. Okay, Nadia, let's go.
they've been okay, not like what we had.
Okay, well, welcome to the Trusts and the Estate Planning Seminar, 2017, not 2016, but the changes took place. Tony, I know that you're online. Can you just send me a WhatsApp or SMS to tell me whether you can hear me? Then I know that I can continue.
And help us. So if we go down the road, we'll stop using any one of those three.
Tony,
Okay, just be
so I can't see.
it's a learning curve for them as well.
Yes, Tony, I've got your message. Right, let's fire away. Let's talk about trust and estate planning. 2017, not 2016, I don't know where that's happened. But let's kick off. I know that many of you will have fiduciary specialists with you in the room. So they will also have, I've got a message from Johan van der Merwe. There's no sound. Tony says that he can hear you. Perhaps just those of you who can't hear, put your volume on.
If we go into a
Johan van der Merwe, I got your message. Can you hear me now? Please let me know. Good. So what is the purpose and the outcome of this seminar? It is aimed at Standard Bank financial consultants. It's also Standard Bank account executives, and I've had many requests in order to do this seminar, and then also some selected Liberty personnel. So what is the purpose of this seminar? Well, first is to enable Standard Trust Fiduciary specialists, and I've given a handout to have a better understanding and to be able to assist our financial planners since they are legally qualified and have experience in trust matters. The outcome is to serve as an update and facilitate a discussion on the latest trust and tax changes. So I'm not only going to talk about the changes that came about, I'm also going to talk about trust law in general, because that remains relevant. So the purpose of the seminar is then also to create a working relationship between Standard Trust Fiduciary Specialists, SPFC and the Liberty Partners, so that we can provide holistic estate and financial planning to our clients. And hopefully that way, then we can create a sustained pipeline of business to ensure that we've got more risk and wills. Just see if I can move on to the next slide and show the presenter view. And there we go. So where do we start? Let's start off with the trust law development in South Africa. And a popular example that I often use is to illustrate that trusts were sold to the public at large for the last couple of years. Every now and then we would get, or quite often we would get a person that is knowledgeable in trust, and because he has more knowledge than the man out there and he has the capability to sell it, people, a whole lot of clients would have entered into trust relationships. It wasn't much regulated, and one could often not tell whether a trust is valid indeed or not, since the Master's Office didn't determine whether a trust is valid or not. And the belief is that there are many trusts out there that is not valid, and we're going to talk today what is a valid trust, and do we have something like a sham trust in South Africa? Because if we have a sham trust, we don't have to worry about the anti-avoidance provisions, because there simply is not a trust. So we had a situation where trust was sold to the public, and there was some court case, Van Zyl and Van Zyl, where it actually illustrates on this set of facts what was the predicament. Now, in this particular case, this person has set up 3 trusts. And he had transferred the primary residence that's prior now to the capital gains into the one trust and some other assets, but the one particular trust was of interest where he transferred his dry equipment, tongs, sunglasses, Ray-Ban, and all these kind of things he transferred actually to this trust. And why did he do that? Well, it was very simple, because he was sued in a divorce case, and prior to the divorce he was looking for help, and someone says, well, you can use a trust to protect yourself against creditors, which in this instance was the spouse. And when the court looked at it, and they says, really, how can you transfer these type of equipment? And I know why they did it. Chances are that you could make a list of this work equipment, similar to what you would give to a short-term company, transfer it to a trust, and you can actually make a donation and get it totally out of the estate. And then when the sheriff would announce his himself at your front door, says, no, here's it, it's all in trust, and they actually get away with it. But in this particular instance, when the person was sued for maintenance, it went to court, and the judge looked at it, and he says, now how could you transfer these Ray-Bans and bright tongs and all these household goodies into a trust and expect for me to believe that this was done for the protection or this was done for the benefit of the beneficiaries? Was clearly not so. So in this particular case, the judge said, you know what, off to jail if you're going to do that, or come up with the money. And very quickly then all of a sudden the person had the money. It is interesting, in this particular case there was an independent trustee, which tells us the fact that you've got an independent trustee means absolutely nothing at the end of the day. It doesn't guarantee that independent person is going to ensure that the trust affairs will be administered correctly, which also questions if there's a real need for this requirement, Sister Parker case, whether we should have an independent person if you're not genuine about it. The point is that we have many of these trusts floating around, and we also saw many divorce cases where trusts were taken on. But from our point of view, what is important, the creditor that we want to look out for is SARS, because this is what this is about. It is about the anti-avoidance provision, and in particular the Section 7 Cap C. But as mentioned earlier, if your trust is a sham, then it never happened. Then there can't be any loan accounts, as a matter of fact. But then those assets actually belongs to the person who intended to hand it over. Now in South Africa, we don't yet have a sham trust. Although there's some case law, we came very, very close to it, but we don't have the sham concept yet, as what we see in what's happened in the UK, for instance. So many trusts are taken on, but not because it is a sham. The real question in South Africa is whether this trust was legally formed. Was it valid? Was there a donation that was handed over? Now that has not yet been tested, and as a matter of fact, in the latest two appellate division cases, which happens to be, once again, divorce cases, where the sham issue was discussed. And a very important one, and the latest two is there, is the VT versus KT, Supreme Court of Appeal. That was in 2015, and last year it was reported, where husband and wife was married in community of property. And there was a divorce. And now the question is whether the spouse, let's call it the wife in this instance, where she would have a claim to the assets in the trust. Because if you can show that that trust was not properly administered, and it was not really intended for the benefit of the beneficiaries, there were no resolutions, there were too much control, in such an event the trust could be attacked and the assets of the trust could be made part of the divorce order, or so they thought. Now remember, we don't have a sham trust. It's another question whether those transactions with the trust were a sham. But in this particular instance, what the person did is, although he married community of property prior to getting married, at the instance of his father, he has set up a trust, but he didn't make his wife, the spouse, a trustee or beneficiary. Now, what's the significance of that? Well, it is important because if the assets are administered for the benefit of the beneficiary, the fact that you are a beneficiary entitles you to the proper administration. And as a trustee, it is required that you fulfill your fiduciary duties. So that is a link that often caused the alter ego principle or lifting the corporate veil, which is not so correct. In law, it is suggested. We had found application, and that for purpose of a divorce, what the courts did is to take some of the assets of the trust and took it into account for calculation of the divorce claim. They never took the assets out of the trust. The one case it did actually happen, which is often regarded in the legal circles as not a good case, as the F&B versus Birds, where the court actually says, you know what, where the creditor was not a spouse, but it was First National Bank in this instance, where the court actually took the assets out of the trust. Another question is, what did the court do? Was the trust a sham? Or was it that particular transaction? Perhaps it seems like that particular transaction was then treated as not really giving effect, because you're not going to give effect to something that you are pretending. But however, in this case where they were married community of property, and the spouse was not a trustee and a beneficiary, the court says, well, that is it. And even though the facts showed that the trust was not properly administered, and even though the resolution wasn't taken correctly, and he acted like the alter ego, in this particular instance, the court did not pierce or go behind the trust form. And therefore, the spouse was left without any recourse and could not claim the assets of the trust. And then just the other day, there was a case on the accrual. Now, in the Jordan and the Badenlos cases years ago, where it all started, what's applicable to people who were married prior to 1984, and there's in the Divorce Act is their discretion that the judge can use. But this kind of spilled over because it's not applicable there to the marriage community of property, or in the case of an accrual that would only come about after 1984. So in the Emphasis N case, once again, there was an issue whether the accrual should be calculated with reference to the assets in the trust. And in this particular appellate division case, the judge actually criticized the previous one where they were married in community of property. And the relevance of this case is that the judge in our courts trying to protect the trust figure, which leads to the conclusion it would not be that easy these days, unless in very specific circumstances, to attack a trust. Perhaps what is happening is that transactions has been attacked. Now, why is this relevant? Because the Davis Tax Committee actually said, in tax law, it is possible to invoke the substance over form to transactions from a tax perspective, and then say, you only did it for a tax saving, and therefore we will not give you a recognition, we will not recognize this entity or the scheme or the arrangements that we're going to look through it. So the question is that possible with a trust? Well, it's possible. But after these cases, and what the Davis Tax Committee said, it's highly unlikely. And if they want to do it, they have to do it on a case-to-case basis. However, if trust law would develop later on, and we are in a developing phase, where you will have a trust declared invalid or a sham, it could definitely be an avenue that the revenue would follow. But it is not an easy way. So, the purpose of discussion, what then did they do? And you will see, with the new Section 7 Cap C, the anti-avoidance provisions, and that's the one with the loan accounts that's going to be taxed. What they did is not to attack the trust. They attacked the loan account. So the substance reflects on the loan account. And the fact that the loan account doesn't charge interest makes it something that's unnatural. So strike two, the trust is still fine. So what did the judge say then in the M versus M case? And I'm going to read to you the relevant part. Although the appellant administered the trust with very little regard for his fiduciary duties as a trustee, and without proper regard for the essential dichotomy of control and enjoyment essential to the nature of a trust, such conduct must justify his removal as a trustee. Or master can appoint an independent one. It said the evidence did not prove that he transferred personal assets, the transaction, to these trusts and dealt with them as if they were assets of these trusts with, and note here, the fraudulent or dishonest purpose of avoiding his obligation to properly account to the respondent for the accrual of the estate. Now substitute that with SARS. So you've got to prove that I'm fraudulent and dishonest in order not to pay the estate duty. I can't see that happening. In addition, it says it was not established that the transfer of assets, it's quite important. You attack the trust? No, you can't attack the trust. Then attack the transaction itself. And this is what the judge is saying. In addition, it was not established that the transfer of assets to these trusts by the appellant was simulated, pretended, with the object of cloaking them with the form and appearance, substance over form, of assets of the trust, which in reality retaining ownership. So here, in this divorce case, the trust assets could not be attacked. I got a message here, Nadia. You have to mute from your side because apparently there is a disturbance. So Nadia, you can just send me a message if you got that, just to mute on your side. Okay, so let us continue then. So the real problem then, what the Davis Tax Committee said, was the loan accounts. So let's analyze the loan account. Because if we can remove this problem, then we can overcome the difficulties with the Section 7 Cap C. Okay, Nadia is muted there on her side. Loan accounts, first of all, is contractual in nature. Now that is very important going forward, because a loan account has a lender and a borrower. So if you have no lender or borrower with a transaction with a trust, you will find that it will not fall within the ambit of 7 Cap C. So a loan account is a borrower and lender, and there are terms of the agreement. It is the terms that is offensive to SARS. Because if the term says that the loan is payable on demand and you don't charge any interest, that is the problem. So you may have a loan and it may be a term loan. But the moment you don't charge market-related interest, which is going to be defined for purposes of 7C, in such an instance is unnatural. So quite clearly an example where they attack the transaction. Immediately, one can ask, did they solve the problem? No, because it's only people who's got loan accounts with the trust that's affected by this. And I must say, most of the farmers that I've dealt with estates, 500 million up to 2 billion, very few of them have loan accounts. So they escape all of this. So the question is, this is where the real wealth is lying. Will something be done about that? Because they only solved half the problem. Good. So when you have a loan account, it triggers all kinds of tax consequences. And the second one is that there would be specific anti-avoidance rules, which you will find in Section 7. 7.1, 7.2, 7.3, 7.5, it carries on to, I think, 7.11 or 13, I'm not sure. So what they did, they slapped on a new one, 7 Cap C. But this new 7 Cap C is the one we're talking about today, about things to be loan accounts. It acts in a peculiar way, because all the other Section 7s, that's the one where you would have funds paid to a minor child of a trust, or you would pay to your spouse, Section 7.3 and 7.2 respectively. All those anti-avoidance provisions relates to the income tax. But Section 7 Cap C has something else in mind. It has donations tax and estate duty. So it is very, very strange that you will have such a provision in the Income Tax Act to counter estate duty avoidance and them not making use of Section 3.3D. Donations tax is incorporated in the Income Tax Act very well, and maybe that is the reason why they thought it will fit well to incorporate this copy and paste method of Section 7 Cap C and just input it into the Income Tax Act. Now I can tell you we'll go into detail in 7C just now, but there is no doubt in my mind that there will be some changes in future. Then over and above that, one will also have general anti-avoidance rules, which are referred to as the shotgun approach. So you will have the sniper approach, which is specific anti-avoidance rules, Section 7. You distribute to a minor child because of a donation, settlement, or other disposition, or you would distribute to your spouse, or you would retain it in a trust. Specific situations, sniper approach will be addressed with Section 7. But the general anti-avoidance, in the old days of Section 103, is now Section 80, actually is very seldom being used by SARS, but it remains relevant. Because I'm going to talk about rollover relief. Because when you make use of rollover relief schemes, if it doesn't work, you're going to get out of the way of Section 7 Cap C with the rollover, but one has always to be mindful of the general anti-avoidance rules, which could have the effect that one can actually pay penalties. So you may save on 7C. So what am I saying? Saying one has to be very careful in these turbulent times, especially this year and the next year, this year and the following year, how we go about in trying to get out of the way of this Section 7 Cap C and the advice we give. And this is what I want to talk about. We're not there to go and advise our clients. We are there to have a meaningful discussion with our clients, that we know what it's about, because it affects the investments we did in the trust. It affects the suggestions to have life policies in a trust, for instance, for very valid reasons. And for that reason, we must at least have an understanding of the basics, but not to go and find ways and means to assist the client with trust law to get out of these onerous Section 7 Cap C provisions. Okay, so now that is a loan account. What's important here? There's always a borrower and there's a lender. And perhaps remember this, it is an agreement. If it is not there, then 7 Cap C can never be applicable. Right, so let's go back a little bit in history before we get to the 7C. The final response document, and I'm doing this on purpose because there was a lot of changes and people still remember the old changes and not the latest that is now incorporated into legislation, and it creates confusion. So when 7 Cap C came out the first time, they said the following, and I've summarized it for you. They said the purpose is to prevent estate duty avoidance. Right, I've got that. What they said, if it's an interest-free loan, a notional amount is going to be imputed to the lender. And what they wanted to do is to say that amount would attract income tax, and you have to put it into your income tax return. So if you get a loan account of $1 million, and then the 8% is the official rate, which is deemed to be market related, then you actually have to take 80,000 and put it into your income tax return as income. And then what you have to do is you must claim that amount from the trust because the trust made a benefit. And if you don't claim it, we will hit you with a donation and we will not give you the 100,000. That was the position, and people are still confused with that. It was subsequently decided this is not what we're going to do. That interest forgone is no longer included in gross income. It's off the cards. It never happened. But what we're going to do is rather exemptions we're going to give to special trust and primary residence. and we'll have a look at the legislation. Then that 100,000 donation that we didn't want to give to you, you know what? You can take it now. So what they're going to do is calculate the interest that you should have paid and convert that to a donation. And if it's less than 100,000, you will not be taxed on that. And I will do an example later on. That right of recovery that you must ask the trust is no longer necessary. And then they also said, let's make it quite clear, it's not transfer pricing is actually something that we don't deal with it locally, but more internationally. So I'm saying this so that you know that there's no longer a deemed interest. They still calculate the interest, but only for purposes of calculating the donation tax. So bottom line is, the change is, if you don't charge interest on your loan account, we're going to do a calculation. And if it's more than 100,000, you'll have to pay the donation tax. And you'll pay that every year, as long as you don't pay interest on that loan account. So that was then the final response document, and all the decisions of the previous response document was accepted, and with other words, that we're not going to go forward with imputing interest on you. But now it's very important. There was a Davis Tax Committee, a first and a second interim report, and they said plenty of things about trust. They said about removing the conduit principle. They said they want to emphasize again on Section 33D. And many things were said. So the question is that, with this legislation, did you consider the Davis Tax Committee, bearing in mind that the second report only came out later? But I can tell you now that second report was lying long time there, and some of these decisions was taken based on the first and the second report. So this is kind of certain. And this is what they said. The DTC proposal said, and this is how Treasury answered it. It says, if an estate owner founds a trust and continues to hold de facto control of the trust, factually he's got control. Like, for instance, to have a loan account or be the sole trustee. He should be held liable for the assets in the trust, including the growth thereon. Remember, we want to ensure that estate duty should be paid. So what did Treasury say? They say we did that, what the Davis Tax Committee recommended. The issue of the de facto control you are talking about, it's not about the one trustee, it's because of that loan. See how they attack the transaction. And we have addressed it by 7C. That's why I call 7 cap C as the sledgehammer. It must just solve everything. And they say by deeming the foregone interest as a donation and taxing annually, the estate owner will effectively be held liable for assets in the trust in cases where donations tax and estate duty could previously be avoided. So what they are saying, if you charge the interest rate, there wouldn't be a growth in the trust and we wouldn't have a problem with you. Even though you could get a higher return in the trust than the 8% interest rate, it doesn't matter. They will be okay with that. So they feel that they did address that problem that was raised. The DTC said, provisions of Section 33D of the Estate Duty Act, this is where the deeming control is over assets in the trust, which we so easily get out of the way of, should be extended to include deeming provisions that identify deemed control of a trust where a loan account exists between the trust and a connected person, where the loan is interest-free or subject to interest loan. Section 7C, they say, well, as we've said, Section 7C is aligned with this proposal. So it seems that the control that they're after is because no interest is charged. And I say, it does so via deeming provision in the Income Tax Act rather than the Estate Duty Act. The key objective is to ensure that wealth transfers are fully taxed. So if you would charge interest on a loan account, there won't be any wealth in the trust, so the argument goes. So technically what they are saying, it's only for the newer trust that's going to be hit. But for the older ones, who's got up to 2 billion in a trust, it's not affected whatsoever unless the trustees employed some bad planning techniques of creating loan accounts to beneficiaries. Because that could be a problem. And we're going to come back to that to see whether that would be hit by 7C and which instances it will not. Right, so let's continue. DTC proposal. Capital gains from discretionary trust should be taxed inside the trust up until the time of vesting or disposal as defined in the 8th schedule. And here they said, although it does not deal with capital gains tax, this 7 Cap C doesn't deal with capital gains tax. It does address the related estate taking issue, and it provides a tax neutral position compared to someone who does not use those structures. Instead of taxing CGT inside the trust, as proposed by DTC, foregone interest is taxed as an ongoing donation during the life of the loan in the hands of the donor, thereby also capturing the time value of money in the growing asset. Well, this doesn't mean a lot, but let me tell you, the big issue, what was not said in 7 Cap C, what was not said in the Davis Tax Committee blatantly, is even those trusts that I refer to that doesn't have loan accounts, which is not going to be hit by 7 Cap C, will ultimately suffer. And that would be not at the moment of death, but if those assets of that trust, which has got no loan account, will be distributed just because of succession planning, 2 sons, each must get a farm, albeit in his own trust, that trust is going to be taxed at a very hefty rate of 45% multiply 80, which today is 36%, which is indeed, it seems higher than estate duty and capital gains tax together. So the trick is here. Well, you're going to escape the 7C, but if there's a disposal for whatever reason in that trust, then in such an instance, severe capital gains tax will be paid. Now, if that inclusion rate would go up, if the income tax rate would go up, you will be negatively affected for all those trusts that doesn't have a loan account. So it seems that trust law and the anti-avoidance is pretty much surrounded what's happening out there at the moment, whether it's an increase in tax rate, whether it's an increase in the inclusion rate, and very importantly, this interest-free loan accounts. The official rate is linked to an interest rate. Now with this downgrade, just because of a downgrade, you're going to be deemed to make higher donations to a trust. That is the effect of it, because currently it's 8%. If interest rate would go up to 3%, well, automatically that deemed donation is going to be calculated on 11%. So there are other factors. The worse it goes for this economy for the next 5-7 years, downgrade taxes, etc., it is going to have an impact on the liquidity on these trusts that are sponsored with these interest-free loan accounts. And then the DTC said some sort of transfer pricing. Well, now we don't have to worry about. It is very clear transfer pricing deals with market-related. Interest that should be charged is usually to do with offshore. We have made it very simple, and we say 7C simply says 8%, and when it's offshore funds, depending on the rate interest that you charge over there. Good, so the explanatory memorandum, now finally Taxation Laws Amendment Bill. And there was an explanatory memorandum to say how they interpret the 7C. So it's quite important that we first find out how does Treasury see it, and then we go and look and analyze how it will affect us. So all it says there is that stating the problem again, so there's the nation's tax that is avoided, and there's estate duty that's been avoided because you are making use of trust interest-free loan accounts. Well, that is setting the scene. So they said the reason for change is in essence the avoidance of estate duty and donations tax. And they're not going to read through all of it. It states the problem once again. So the proposal is what we're going to look at just now, and they say only certain loans would be affected. And there they go. They say, for purposes of 7C, if you don't fall within 7C, you're not affected. Affected loans will be interest-free loans or interest below market rates that are made to a trust directly or indirectly. They are the key words. Loans made to a trust, not from a trust, to a trust. And then they said directly or indirectly by two people, a natural person or a company. That must be a connected person, and then explain what connected is. Usually the problem is with the natural person. Then they say this will become effect from 1 March 2017. So SARS is starting to count from the 1st of March 2017. And if you can get rid of a loan account or start paying interest, you will only be up until today be liable for what you have taken away from SARS. Now, the best way to explain, I've given you the background, is to make use of an example. So this is an example that SARS has given us. Just want to look it up. And they are the facts. And then I'm going to do it schematically. So I'm going to go through the facts, and then I'm going to go through it schematically for you. Mr. Planner's spouse and 3 children are beneficiaries of the Q Trust. The Q Trust is the only beneficiary of the T Trust. So it's cascading. And there's a reason why they do this. Mr. Planner advances a loan of 5 million to a business associate, a friend of his, that is not connected with any of these affairs. But that loan is non-interest bearing, payable on demand, and subject to arrangement in which Mr. G, this business associate, will make an interest-free loan to the T Trust. Remember, why would they do that? The thinking is that if you don't make a loan to your trust, then you can avoid it. So what this person does is make a loan to a friend of his, and a friend of his will make a loan to the trust, and then they have some kind of arrangement, a security for the loan that Mr. Planner made. You will just see that quite clearly circumventing the first section 7C1 of the Income Tax Act. So then the T Trust will then use those funds to acquire shares and interest-bearing assets. So let's go through it. There I've done a schematic example. If you will see, there's the T Trust, and the only beneficiary of the T Trust is the Q Trust. So that could be a business trust in the old days, and that one could be the family trust, for instance. And then the beneficiaries would be the wife and the children, and usually the income would flow through there and distributed to the children. That is how the thinking was. The risk would be here, and there would be no risk. Typically how trusts are set up. So this trust would then be the investment trust that have shares and interest. So what we said what happened is the taxpayer, Mr. Planner, he made a loan to a friend, and then that friend makes then a loan to the T Trust. So Mr. Planner never made a loan to a trust. So he could argue or fall out of the 7 Cap C. How does SARS view that? A clear example that the taxpayer made an indirect advance to the T Trust. So he might as well just done it in his own name. So what are we learning from this? That clever scheme, it is simply not going to work. But then SARS continues with this example, and he says something very, very interesting. Distributions that are made, the manner in how those distributions are made is very important. Now, I can tell you, most of the cases out there that I've seen is in order to do this income splitting, what I spoke about earlier, is the capital gain or the income tax would be vested in that particular beneficiary who's paying very little tax. But the assets will not be made over. In return, that beneficiary will advance the funds to the trust, and there the word advance comes in. And immediately you fall into Section 7 Cap C. So that child, he didn't receive the assets, he has the right to the asset. All the monies. But no transaction or no monies were flowing back and forth. The child would simply now make a loan to the trust. So in financial statements, you'll see there are loan accounts created. And how are they created? They don't charge interest. And the question is, will 7 Cap C apply? Yes, absolutely, because there was an advance. And that's why I went through loan accounts. If there is a contract, a borrower and a lender, you with in 7C. So all those issues that we find in practice will be affected. If you did proper trust administration, what you would have done is to distribute that asset and vest it in that beneficiary. But in terms of the discretion of the trust, you hold back on that asset until the child is 25 or until the trustees decide in their discretion to do so. And that must be written into the trust deed. And I think many trustees don't have that before you can do that. In that particular instance, we cannot talk about the child making an advance to the trust. There is no agreement. For a child to, for money that's distributed to him, no acceptance is necessary. However, if the child would take that interest, not receive it, and make a loan back to the trust, and those funds are not kept in a separate account for that child, he's made it back to the trust and he falls within the ambit of 7 Cap C. So, I think this year, accountants will be very busy to say, no, that's not what we intended to make a loan. It can be recorded as an amount, but it must never be a contract or advance that the beneficiary has made to the trust. Those people will be hammered. In Sa's particular example, he says, if Ben turns 25, because that's the condition that he can get it, and then he says, I elect not to be paid, then effectively he's made an advance, and that means he entered into a contract, and that means we're in the situation of a borrower and a lender. That moment, 7 Cap C will apply. So, the golden rule is, once there's an agreement with a trust as a borrower and a lender, and the terms are such that it's zero interest or very little charge, you will fall into the ambit of section 7 Cap C. Okay, so let's drill down a little bit and let's have a look at 7 Cap C, and then I'll do some more examples. 7C, there are 5 subsections. So let's read it, and I'm going to unpack each one step by step by step. 7C says, loan or credit advanced to a trust by a connected person. This section applies only in these particular instances in respect of any loan, advance, or credit. Now, for some reason, now they talk about loan, advance, and credit, but the heading will talk about loan or credit, which begs the question, is there anything specifically meant by credit or loan? And our thinking is no. It doesn't matter. It simply means the loan that we are talking about, not a borrower and a lender. But it says that that natural person, or at the instance of that person, a company, directly or indirectly, which are discussed already, provides advances to a trust or any other person that's a connected person. The key word is to a trust. So if a loan is from a trust to someone else, is that HITRA 7C? No, it must be to a trust. That is why you will also find that loans made to a company where the shares are in trust. It alone is to a company. That's why it doesn't fall within 7 Cap C. So the key word, it must be a natural person to that trust. Does it say it's from one trust to the other one? No, they don't say that. So it's not applicable between two trusts. It is from a natural person to a trust. Remember the words to a trust. Then number 2, they say no deduction loss will be allowed. And I'll give you examples of that. And number 3, how are they going to do it? This is what this subsection says. If a trust incurs no interest in respect of a loan, advance of credit, blah, 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 referred to before, or at a lower rate than the official rate, then this applies. So you may have a loan account, but the moment it's a low interest, then it will apply. And what will happen? It will be treated as a donation. Now, we know it's not a donation. We know you did not have the intention. You did not have the animus donandi. But for purposes of the nation's tax in the Income Tax Act, it will be deemed to be a donation and you will be taxed accordingly. Section 7C4 is not an important one, that is just an apportionment. The more important one is number 5, and where it says, these sections above, the 2 and 3, there are certain exemptions, and then we'll go through the exemptions, and I can tell you now where it's a PBO, a special trust, etc. So this came about subsequently, and to make it clear which instances one will not fall within the ambit of 7 cap C, even though you would have an interest-free loan account, then it will not be applicable. And so it continues, and then the right at the end, it says it will be made applicable from the 1st of March 2017. And all those are still the exemptions. Right, let's unpack it now step by step by step and see if we can have a better understanding. Number 7C1 is a very important one. The section applies in respect of any loan, advance, or credit that the natural person or at the instance of that person, a company, makes to a trust. So a natural person or a company makes to a trust. Quite clearly, the purpose of the legislation is to prevent any estate duty and donations tax. And even though you would make an interest-free loan, all those anti-avoidance provisions of the income tax, those sniper ones I spoke about, they are still applicable. It doesn't mean it's one or the other. They are still applicable. And what we have learned over these years, how to deal with those anti-avoidance, they still remain applicable. Whether it's fair from a SARS perspective is another question. It actually favors us to have these anti-avoidance provisions, but they're still on the books because effectively we're paying a lower rate. Technically, those anti-avoidance provisions, Section 7, 1, 2, 3, 4, and 5, and so on, they were done at the time when the tax rate in a trust was lower than what it was for the founder and his spouses and beneficiaries, etc. That's why they brought it in. But now we find the opposite. And that's why the Davis Tax Committee questions whether we should still have it. The point is, we still have them. As stated earlier, loans made to a company and the shares of the companies held in trust is not affected by this. But in the budget speech, it was said that we will see changes and anti-avoidance legislation that will be drafted. So what does this tell us? It tells us that this section, as you see it here, is not the end of it. It's going to be a change upon a change upon a change, because this one is already relatively drafted. So there will be more changes looming. What does this spell out for us? Well, be very careful when you go into complicated structures to avoid 7C, because you just may have to redo the whole thing next year and the year thereafter, causing the client a lot of grief and giving a wrong tax advice. It's very uncertain and turbulent times, so I would be very careful. Furthermore, if you manage to do that, you can always fall into the ambit of the general anti-avoidance provision, and in terms of the Tax Administration Act, being hit by penalties. The next one I want to talk about is the second point, subsection 2, is no deduction, loss, allowance, or capital loss may be claimed in the respect of a disposal. Well, think about this. You've got a loan account to a trust. You say, oh, well, I just waive the loan account. If I would waive the loan account, then perhaps that could be a capital loss, and I would be able to claim a capital loss, albeit a reduction of the base cost of the assets in a trust. Well, it's going to be a donation, but if it is because the trust is actually bankrupt, what then? So I was thinking that where could this be applicable? And perhaps an example would be of cases that I know that happened the last 2-3 years, where a taxpayer made an interest-free loan to a trust and purchased then, the trust purchased an endowment policy, let's say for 10 million. But that endowment policy now has reduced in value for whatever reason to, let's say, 8 million. But your loan account is still 10 million. And 100,000 is just not enough to write it off. So here you've got a loan account of 10 million. The value in the trust is only 8 million. So can you write off that loss of 2 million? Well, apparently not. You cannot do that. What is interesting from a state duty point of view, if we would value that loan account, it would be 8 million because that is the market value. But the Section 7C causes quite a problem. So when people have entered into these structures, I have absolutely no idea how it's going to be dealt with, because even though you would cash in the investment, repay the 8 million, what happens to the other 2 million? Well, if it's going to be a loss, it is going to be a capital loss that you actually won't be able to claim it for. And how practical and how realistic it's going to be, I don't know, but we will have to see how that's going to be implemented. Now, how do they calculate it? If a trust incurs no interest in respect of a loan, advance or credit, or, note the words or, interest at a rate lower than the official rate of interest, then they say, and watch here, an amount equal to the difference between the amount incurred by that trust during a year of assessment as interest in respect of that loan and the amount that would have been incurred by that trust at the official rate of interest. So what they are saying is very clearly, if you have a loan account, you charge 0% interest, we're going to assume that the trust could have incurred 8% interest. So the difference between 0 and 8, that is going to be the donation. But it's quite clear that this legislation is shoddy. So I would ask, so let's assume for some reason you charge the trust 13%. Quite clearly far more than 8%. There is no doubt that there's going to be estate duty savings because the rate that you charge is so high. But when I read the section, it says even in that instance, the difference between 8% and what has been charged could perhaps be a donation. Surely that was not intended, and definitely not. And it will never be applied like that. But that just shows you that we can be quite certain that there will be some redrafting and to make sure that the legislation is not a spook and plug and actually makes sense so that we know how to deal with it. Then how do we get to 8%? You look at the 7th schedule. In the case of a debt which is denominated in the currency of the Republic, it's a rate of interest equal to the South African repurchase price plus 100 basis points. So the repo is on 7%, you add 1%, and that's how they get to the 8. Where it's in another country, the rate of interest is equivalent to our repo, if that's 1% plus 1%, so the offending would be 2%. So I will give you an example. So let's just do a very simple example to make sure we understand what we've learned so far. Taxpayer made a loan to his trust amounting to 10 million. Taxpayer charges no interest on a loan account for the year of assessment. What is the donation? 10 million multiply 8% official rate. With the downgrade, it goes up, that goes up. It's 800,000. Donations tax, you get the 100,000 exemption. So that's 140,000. So the taxpayer will have to pay 140,000 each of the future years of assessment, so long as that loan account does not charge interest. What if a taxpayer charges 5% interest? Well, then you take the difference. In such instance, it would only be 40,000. Then we get Section 7C5. Now, I'm not going to go into detail with that one, except for if it's a vested trust, well, there can be no point in estate duty savings, but there are very strict rules that it must be 100% vested, no discretionary nature whatsoever. Such circumstances, it will not be affected. And then it also says if you have a primary residence, to that extent, also it would not be subject to donations tax. Just going back to the previous slide, if the loan account would be 1,250 million, you calculate 8% of that, it would be 100,000. So one can safely say that loan accounts that's less than 1,250 million will not be subject to the provisions. And then perhaps if you are made a community or property, why not double that amount? So those people with small loan accounts less than 1.250 million need not to be concerned about this. Here's another example to give you another illustration. Here we would have Mr. X. He would make a loan of 5 million to a South African trust, which is his family members, and he would make one to an offshore trust. So the loan account would be $1 million for this one in US dollars, and the rate is 1%. How would we calculate the donations tax? You take it on the last day of the year, which is 1650, and you're going to convert that amount. We do not take the average amount. We take the amount at the end of the year. So where the rand is devaluated, it will have a difference in the tax calculation, and this would be applicable because exchange rate is lower. So in this result here, there would be two donations. The offshore one is $1 million multiplied 2 minus the 1% because he's charging 1 and the official is therefore 2. $10,000 converted at 1615, it's 165. South African trust, very simply, 5 million times 8%, there it is. And there's the exemption of 100,000, and every year you'll pay 93,000. It illustrates the point that it's in the end of the year. What if it's a loan to a trust by a company? So you make a loan to an offshore company, that would make a loan then to offshore trust, and property would be bought in Italy. By the way, these are examples in silk. Those of you who want to read more, you can use this diagram. I just simplified it. In this instance, it matters what is meant by instance. If it's made at the instance of Mr. X, then the full amount would be attributed to him. And there I've done the calculation, and I've done it for the portion of the year only, and I've used up the other donations that he's used. So in this particular instance, he will pay for it. The question is, if it can be argued it was the instance of Mr. X and Mrs. X, there would be no tax payable because you would divide that amount in two, and she's entitled to 100,000 exemption. So the word at instance leaves some tax planning opportunities to a limited extent, because at the instance is at the request of. It's not who's controlling, it is at the request of that person. And then, as I said earlier, the budget speech in 2017 said, taxpayers have already attempted to circumvent the anti-avoidance provisions by making low interest or interest-free loans to companies owned by a trust, as I said earlier. To counter abuse, it is proposed that the scope of this anti-avoidance measure be extended to cover those avoidance schemes. So you bet there's new legislation. So before you start going and all the rollover, be very, very careful before we start trying to get out of the way of it. What should we do now? Following options. Since there are amendments on the cards, wait and see and pay this year your penalty. Get rid of the offensive loan account, but remember you're going to pay tax on the trust in order to repay the loan account. Or you can simply just unbundle the trust. For some people it's worthwhile. Or if you can pay interest on a loan account, at least to the point where you get the 100,000 donation. Or if your trust is generating income and he can claim the expenses as a deduction in terms of 11A, then it may not be too bad. But most trusts only have capital assets and aren't trading. Then bite the bullet and pay the donations tax. And as I said, be careful of aggressive planning. How do we move forward? Let's go and look at your trust. Each and every person, go and look for two things. Make sure that that trust is valid. The transactions are genuine. Don't only look at the resolutions, it's what's in that resolution. That is important. Have a look at those loan accounts that were made, because that is going to trigger the donations tax if it falls in the ambit, as I explained. And in succession planning, look for events that can trigger a disposal of an asset because farmer wants to give to his son, etc. Because in such instance, you will pay 36%. So let's end off. Trust advice and the professional financial planner. We only deal with trust where it's incidental to the outcome. If you do a buy and sell and there's trust involved, you must get the fiduciary trust specialist involved to assist with the transaction, because it is your duty to make sure that the trust can actually enter into those agreements. In other words, you have to do a due diligence on the trust. But it's incidental to the outcome because we're doing a buy and sell for purposes of insurance. We don't do audits. We don't go and tell people how to get out of the way of 7 cap C and do rollover reliefs. It's simply not our place. We do this so that at least we can have meaningful discussions with our clients. So when the auditor would talk about the 7 cap C, we have a general understanding, but never ever to give advice. Only where it pertains, where we put a life policy in a trust, where we put investments in a trust, and we're going to create loan accounts. Be very mindful the negative impact of those loan accounts. And I think that sums up the advice limited that the professional financial planner must get involved with, and that goes for the fiduciary specialist. I always say you never give advice if you don't get paid. So make sure it is relevant to our product and make sure that it is a compliance process. And ladies and gentlemen, I have had a session with the fiduciary specialist and we went into a lot more detail than we did now. Feel free to contact them, talk to them, and ask them to assist so that we all can optimize and do better business. That is all from my side, and thank you very much. I don't know if there are questions. I can't see them on my side, but Nadia, I guess you will tell me about them. Thank you very much.